All right, all right, all right. Good morning, everybody. It is a beautiful Monday day out there. This weather is gorgeous. The fall is here. That means it's listing season, Johnny, in Manhattan real estate. Good to see you here, Johnny. That is Johnny Walkup, best last name in the real estate industry across the country.
Well, I like to remind you, that it's pronounced penthouse, but hey, that's okay.
Oh, okay. Okay, I've got you. I'm just messing around, giving a couple people some time to join in there. That is John Walkup. I am Noah Rosenblatt. We are both with UrbanDigs, and it is Monday, so you're going to get a little macro Monday coming right at you. For those of you that are new to this show, we're going to start out with Manhattan real estate because that's where our business is focused on. And we're going to do some monthly trends. Where are we now? Where are we supposed to be for this time of the year? And then we're going to pivot and we're going to go talk about some macro stuff. We'll touch on credit spreads. We'll look at the Fed fund futures for interest rates. I got a couple of national housing charts, et cetera, et cetera. And then we're going to circle back to Manhattan real estate. And we're going to try to do all of this in 30 minutes or less, John.
30 minutes it's free, or less. As we like to say. That's right.
Or it's free. It's free now.
Follow those rules. Yeah, there we go.
Yeah, you can't get more free than free, Johnny. Little housekeeping over here, guys. We will talk some financial stuff. We will talk about the tradable markets. None of this stuff is financial advice. My lawyer told me to say that, John. So I'll have to repeat that a couple times. Don't start day trading this stuff at all, even though you want to.
Don't do it.
Okay.
Especially when you know
it's fun.
It's a bad idea.
Trading is fun. All right. Let's get going, guys. I'm going to look at the screen right over here. I'm at the market ticker here on the UrbanDigs dashboard. I clicked on 1 month. We are looking at supply. We are looking at contract activity, 30 days, the last 30 days. Supply is at 1379. You could see, guys, you could see that the season turned on. The lights came on a couple of weeks ago. That 1379 is supposed to end the month. Let me check my notes here. 1757, John, is what our normal is for September listing activity. So we're getting there.
We're on our way. I think we'll get there. I mean, if not, we'll either get really close. We might even go above. We'll see. But it's interesting to see how this pace is going to play out over the next few weeks, given the fact that it's been kind of light over the last couple of years.
Yeah, but there's been talk that inventory is tight and that not a lot of new listings are coming on. So I'm just curious how this season's going to progress, especially as we get closer and deeper into the fall season. But nevertheless, we're at 1379. That's supposed to be at 1757. So we have some level of benchmark to relate it to, but we got another couple of weeks. We got to wait. Okay.
Yeah.
Contracts signed. That is our deal activity. You can see it's looking 30 days, 652 of them. We're supposed to be at 707 for the end of September. What I'll tell you is this is seasonal market dynamics, right? September is when the stuff comes on. October is when the stuff goes to contract, right? It takes a little while, accepted offer, deal activity, contract signed. So the fact that this is at 652, it's not worrisome because we got 2 more weeks left in the season until we got to look at that number relative to the average of 707, right? But this typically bottoms like the 3rd and 4th week of September. So another week or so until it bottoms.
And that's why I always find the fall to be one of the trickier markets, because that you have usually a big rush of supply coming on at the same time that demand is basically bottoming out. So it always appears a little tricky. And we've actually put out an article in Forbes kind of giving a fall preview, talking about some of the inventory and supply side dynamics and how they can, obviously your mileage is going to be different, and as you get closer into fall, this hopefully will shape up. But it's always a little spooky just to get started.
Yeah, and look, 2 years ago we bottomed September 25th. Last year we bottomed September 16th or so. So we're right around there.
Right in that.
Right around there. Exactly. Okay, so that's that. That is that. If there's any comments on that, let us know. But I am going to pivot to the macro portion of the program, Johnny, which means we're going to go right to credit spreads. Credit spreads. I know a lot of people ask me, why the hell do we even look at credit spreads? We're in Manhattan real estate. Well, first off, this is Macro Monday. It's different.
Macro means big. Big picture.
big picture, right?
This is
credit spreads.
As a big picture as you can get. I mean, this really is.
Yeah, this is
the reason we look at it. It's like early warning kind of thing. So this is a broad look.
Yeah, this is our DEF CON indicator. DEFCON, I don't remember which one's the worst, but this is DEFCON 1, 2, 3, 4, 5 kind of thing. And we're at DEFCON 1, which is low. I think it's low, unless I'm reversing them. Right.
Yeah, you're reversing it, but that's okay.
Yeah. So it's risk on, guys. This is a market signal. This is a market signal, right? A lot of traders and hedge funds, they're looking at credit spreads. Okay. And what you need to know is that as this little indicator goes to the right and goes higher up, right, the credit stress embedded in the global economic machine is rising. That's not good. It's not happening right now. It's going down, right? You can see credit's going down, right? If I click max on this chart, you can see how this went up. Look how it went up. It was warning. It was a warning of the great financial crisis right before that happened. And look at the pandemic. It was warning of that. And then as it comes down, that's the recovery from that.
Yeah.
So we're low on credit spreads, which is risk on in the markets. No warning signal.
Yeah, and it's all about intensity, right? Direction and intensity, and you really don't want an up direction with a lot of intensity. That basically says there's something broken in the plumbing, in which case, things
Correct.
can start breaking downstream. However, little tiny moves, I'm okay with them. It can go a little up, it can go a little down, as long as it's a little tiny. That's what I'm here for. So,
correct.
Keep away big moves.
The reason we look at this, right? The reason we look at this, I can go 5-year, I can go max again, is because as this widens and credit stress rises, banks cut back on lending,
right.
Stocks sell off. We call that risk off. It's a deflationary period in time, right? We don't want that. Deflation's no good. You need inflation, okay? People lose their jobs. And if you just go down the trickle down effect from stocks going down, from banks not lending as much because it's a rising unemployment environment kind of thing, well, that means that buyers of Manhattan real estate, investors of Manhattan real estate are going to pause on their bids or lower their bids or just back off. So yes, it does trickle down into us, but I don't see that. Right now, I see nothing. So no warning sign. Okay.
Yeah.
Good.
I concur.
Moving on.
Okay.
I concur. Absolutely. All right. We're going to go to the interest rates segment. Johnny, to do that,
Let's go.
We are looking at the Fed Fund Futures. These are big words, guys. Fed Fund Futures. You know what another word for Fed Fund Futures is? The bond market. It's the bond market. It's the market, right? It's the market. Okay. We are at the CME Fed Watch tool. It even says that right over there. You guys could do this yourself. I want you guys to focus on this table, okay? And what you need to know is that we are actually in the box up here. That's not even on the table. Like I'll take it off. Look, see? How do you know where we are?
We are on uncharted waters currently.
we're
we've been here for a while. So
untabled waters.
So we're gonna get back on the map on Wednesday.
Yeah, that's true. Well, you think so?
Well, yeah.
You think this is going to get back up there?
What's going to be interesting? Well, here's what's going to be funny is on Wednesday they're expected to cut the quarter point, right? That's the 96.2. When that happens, all of these boxes are going to shift, and then the new expectations are going to what fills in the box. And so my guess is we'll probably stay here, right? You look at October 29th, they're about at 80%. They think another rate cut. So we may be off the thing again, but we'll see. You know what I'm saying? That column might disappear, but I think it'll stay.
Right. All right. So when is September 17th?
This is, by the way, is how I have fun. I look at the Fed table and just kind of imagine what it could look like.
Well, I didn't realize it's so close, to be honest with you. But let's just go over this, guys. Let's go over this so you understand what this table is saying. You understand what to tell the people, and we understand what's happening, so we can have smart conversations, right? We are here. Each one of these move downs is a quarter point. If it was going the other way, it would be a rate hike. That's not happening. There's nothing on this table. There's no boxes going to the right, so there's no hikes. It's only cuts, right? Each is a quarter point. The next meeting date where the Fed's going to make an interest rate decision is on the 17th, and the market 96.2% believes they are going to 1 quarter point cut down to this new level. Okay. So yes, rate cut coming. If it does it, markets might react negatively. I don't think that's going to happen. October 29th is the next meeting. They got another cut. Okay. And then December 10th, another cut, 73.8%. So what you guys need to know is that there are 3 rate cuts that the market is pricing in right now. And this is why mortgage rates are going down. They have been going down. The move is priced in. Yeah, it's priced in already. Okay. And I want to overlay something. Goldman Sachs. You ever heard of Goldman Sachs, John?
I've heard Goldman. I don't know about Sachs, but yeah, definitely.
Well, Goldman Sachs came out with a note, and I'm just going to read the top section here of this note. I overlaid it on so you guys can read it yourself. This is Goldman Sachs saying we expect a 25 basis points, aka 1/4 point, 25 basis point rate cut at the September FOMC meeting to be the first of 3 this year. We know that already because we just showed you that table, which you do it every single Monday. So you don't have to be at Goldman Sachs. You can be right at UrbanDigs back on Monday. We'll know the same thing. Okay. The increase in the unemployment rate over the last 2 months and the decline in job growth to below the break-even rate makes supporting the labor market the Fed's top priority. We expect 25 basis points, 1/4 point, cuts in September, October, and December. Okay. That's what you guys need to know. Goldman's saying the same thing. That's what the table's saying. I am not looking at the other cuts in March and June and next October because it's just too far away and these percentages are too low. So guys, use caution. 3 cuts so far, definitely 1, most likely 2. I don't know about that 3rd. We'll see what happens, but the market is expecting it.
Yeah, and there's a fantastic question in the chat. It says, if we look at what happened last September when they dropped the rates, inflation and unemployment were both a tad higher, and yet the mortgage rates went up. Do you think that could happen? So that's a great question. At what point, first of all, which of these rates do you think is priced in? Do you think we're priced in, all right, just the first rate cut, or do you think we've got 50 basis points priced in? The second is, what's to stop mortgage rates from going back up again?
So, okay, that's a fantastic question. So first off, I want to go to mortgage rates and let's just answer that first part of the question. Here's mortgage rates, guys. And you can see this chart. The light blue is 30-year jumbos. Dark blue is conforming. You guys should know these kind of things. And like the jumbo, we're at the lowest rate since last October. Like, again, we have moved down over the last few months. That's notable, guys. That's the market now pricing in more cuts. So it happened already. This is the hardest thing for traders to kind of grasp, right? The markets trade on future expectations, not today. They look in the future, right? Yeah. So let's say the Fed comes and cuts. Let me just get this point across, John. Let's say the Fed cuts in September, okay? If this table changes and those things move to the right, these things move to the right because the statement that the Fed issues is going to say, you know what? We're still worried about inflation. Then rates are going to go up. So even though you get the cut, it's the statement about the future that might drive the rates. And that's the key right there, that statement.
Yeah, and so when you're talking about forward expectations like that, I think that's one of the reasons why we like to use this particular table on the CME, because it kind of aggregates those probabilities. But B, it's those white boxes that also kind of tell a tale, and that's sort of where the market participants are sort of outside the window, and they kind of provide you a gauge on which way the market is leaning. When you start seeing those, bunch up to the right or bunch up to the left, you kind of get an indication of what that slope might look like. And that kind of gives you a hint toward which way rates and perhaps mortgage rates might go as that starts to fill out a little bit.
Yeah, that's exactly great point, John. Watch the blue trend line, guys. If that goes to the left, mortgage rates down. If that goes to the right, mortgage rates up. Simple.
Yeah. You can think back. It was like 6 months or so ago. Remember, it was like we just had like just a couple.
Yeah.
Yeah. So
I know it's changed a little bit. It's changed. So that's what we got to know. That's why we have to be careful what we say, right? We got reputations as agents. We don't want to tell our clients wrong things and put ourselves in a spot. So just read the tape. Fed fund futures, 3 cuts this year. After that, it's too uncertain. Okay. This market just keeps going, by the way. You know what I'm saying? And this is why we look at credit spreads, because as long as credit spreads are staying at or going down, this bull market, look at the red line. This bull market just could continue, even though I think nobody believes this rally. It's like the most hated rally, Johnny.
Yeah. Well, because there's a bunch of risks that are still out there, right? I mean, you have AI is a huge hype, right? Right. That's
what's
really
AI?
I don't know. People talk about it. I hear it a lot. I like to think it's agent intelligence. That's what we're all about here at UrbanDigs.
Okay.
It's really about artificial intelligence. It's computers talking to other computers.
Agent intelligence.
Stuff that is completely hallucinated sometimes. Yes. Look, you've got earnings valuations are pretty high up there, right? Just the market could take a really setback if those
market's pretty high.
Predictions don't necessarily come through. You got political risks out there, right? You've got job numbers kind of questioning. So we definitely still have some risks, even though this is why, just to add credence to your point, that this is the most hated rally. So it just keeps going up despite all these concerns.
Yeah, and I mean, you look at other bull markets. I mean, it's happened before. Like it could happen again. I just don't think anyone believes it. There's a lot of shorts getting hit. I mean, I don't know. It feels melty uppy, is what it feels. Melty uppy. And as long as credit spreads are not going up over here, widening over here, I don't know. I mean, this could just go on a little longer than we think. So, bull market's alive and well for now. But yeah, noted, John. There are risks out there. We'll keep an eye on those. Okay. I want to go to a national housing element here. Building permits. Like, we don't talk about this kind of stuff at all. So I figured it'd be good to get out of our little Manhattan bubble, take a look at national housing. We do this every show for a few minutes. They're not building. I mean, it's very regional what's going on across the country, but in general, builders, permits going down. What's your take, John?
No, well, they are. I mean, that's what the chart is showing. Of course, this, I don't know how correlated this is to mortgage rates, but the idea is that, I mean, it started, falling down right around 2022 when mortgage rates started going up, but they haven't really fallen off a cliff. I mean, that trend is down certainly, but it's nowhere near the kind of fall that you saw during the great financial crisis during those times.
Right. So
they're just a set lower. They're not falling down, but they're definitely lower. However, I think as you see mortgage rates start to tick down, I mean, this is, I think my broader view is that as we sort of enter a new environment in which mortgage rates could be below 6%, you might start getting some of that buy side activity back, especially in some of the markets that we're going to talk about this soon, like in the South, Florida, et cetera, that have higher inventory, right? So you get some sellers out there, you got some buyers. Those markets could get restarted again, and that regoing. I'm going to start using that.
That sounds good enough to be a word to me, John. It should be a word. It should be. It's a sniglet. Remember that, rich little sniglets?
So no, it'd be nice if we could. He was great. He was on Saturday Night. He had like a whole little book. Made up words. Anyway, I think that thing that could turn around once we get into a new mortgage rate environment, if they do manage to go lower and stay at a sustained level lower.
Yeah, and I think this is one of those market signals right here that is telling me, right, it's not very clear in what it's saying. It's going down, but it's not tanking, as John said. And I think the structure of this housing downturn is just going to be so different across the country. It's going to be especially different for us in Manhattan. You guys know that already. But usually the country kind of does its own thing, and then the urban centers do their own thing. It's kind of like suburbans. Now it's different. I mean, now it's just like region. It's Northeast versus Southeast versus Central. So it's really very, very, very different. I want to put up a comment that Bianca made. Okay. I thought this is really, really spot on. The Fed only controls the short-term rates, which is exactly true, guys. The Fed does not control what the 10-year and 30-year yields are doing. Okay. The Fed controls. That's why we look at the 2-year Treasury note to see kind of what the market thinks the Fed's going to do. Sometimes they usually go together, but sometimes one goes one way and then the other follows, kind of thing. So anyway, if the marketplace controls long-term rates, if the market does not like or trust that move, they will compensate for that by allowing long-term rates to float up. And that's exactly true. That's exactly true. So this is a good example of, at some points, the bond market will force the Fed's hand and do their own thing. So I thought that was really, really interesting. Oh, it's Roberto. Oops, my daughter's iPad. That's Roberto. Roberto, I should have recognized the last name, Cabrera. Well,
you should have.
Hello, Bianca.
That's going to have to go in the file, Noah.
Okay. Thank you, Roberto.
No,
Thank you, Roberto.
That's an excellent point. And that's one of the safety valves we have in the economy, is that sometimes the Fed can do something and the bond market says, "Well, you're crazy," and they start jacking up rates, and it pulls people back. I mean, we saw a lot of that unfold over in the UK as they had some policies which were geared to get the economic engine going again. The bond market did not like it. Yields shot up and the politicians backed off. So it is a bit of a safety valve mechanism.
Yeah, exactly. I thought this was interesting. This is from Moody's Analytics. Okay. And they have these recession risk indicators, probability of recession in the next 12 months based on a machine learning model. I mean, in no way is this like, 100% accurate, but they do model these things at Moody's Analytics, and they came up with the trend and they come up with a threshold. It's like our climate index, John. We got the challenging, we got the easy threshold. And then when you get up to that threshold, you got to kind of, change your stance. Same thing with here in terms of recession. And again, this to me tells me like that again, everyone's kind of fearing a recession, but I don't know what metrics this is looking at, unemployment or something like that, but it's getting near recession worries level. I don't know. I guess we'll see if it pans out.
I know. Well, it's a flashback to a couple of years ago when we had the inverted yield curve and the talk for a year, 2 years as well. An inverted yield curve means a recession's coming, and it just didn't come. So yeah, sometimes these things are really meaningful until they're not, in which case it's like, oh, that was interesting. What's for lunch?
Exactly. So as far as recession, when I think recession, like I think not only the terrible part of job losses and all that kind of stuff, the human element, but I think like stocks going down. I think of a negative wealth effect. I just all these, derivative elements in the markets that make fear and uncertainty go up. And then there's nobody invests, nobody builds, everyone pauses, right? So I just wonder if that's going to be completely different this time around. I mean, I don't know. Maybe you'll get the rising unemployment, but maybe you won't get the 30% market crash, for example. I don't know. Just saying. Okay. Housing? What is that?
I tend to agree. What can I say?
Oh, okay. I feel like, what I feel?
You were just saying, I was just, what was that?
That was the gong, John.
No, okay. I got the gong. Had to happen at some point.
That's what I feel like saying. Wow. All right, we're gonna move on from the recession indicator. We're gonna go shift to housing a little bit. Housing here. We talked about national housing. This is national active U.S. housing inventory for sale according to Realtor.com, guys. Just take a look at 2025 and look at all those lines beneath it. Right, that's not happening in our market.
No,
by the way, no.
I think we did this last Monday. Macro Monday, or was it Friday? We talked about where supply had come in through the summer, and it was one of the lower ones, right? We had massive gains, 2020 to 2022, and then just kind of fell back off. So we went from the big numbers to the small numbers, and we're still pretty much in small number territory here. Supply with lowercase s.
And you got this rising supply across the nation, but when you look at it, when you look at the country in terms of inventory, I love this guy. I love Resi Club. I love Lance Lambert. You guys can follow him. He puts a lot of great stuff out there, a lot of national stuff. I know we're in Manhattan, but it's just good to have a general idea of what's going on in our market in case somebody asks you, why should I invest in New York City? Like, why? You should have a good answer for that kind of question. And this map will give you a good answer, because what's going on in the Northeast with inventory, look at all those dark browns over there. That's negative 50% inventory shift over the last 6 years.
I thought this was a foliage map.
Yeah, no, it could be. It could be a foliage map.
Yeah.
But it's just such a regional housing market. And I keep repeating this, but like whatever national housing slowdown is going on right now that they're neck deep in it. They're in the 5th inning, 6th inning. We're just seeing a completely different thing in our little sector.
I know. And it's worth noting that like many of you, I end up talking about real estate pretty much every little party I go to, cocktail party, whatever it is, afternoon picnic. I'm out there. Someone's talking about real estate, and I'm usually someone they talk to about it, which is, I suppose, fair, since that's what I do for a living. However, one of the things I have to always explain is that people read these headlines about what's happening in the national housing market, and you can't extrapolate that to our own local market, because what's happening here is completely separate to what's happening in, say, Austin or Fort Lauderdale or Miami. These are totally separate markets. They have their own dynamics. They're very, very local. So yeah, when you round up all the numbers, sometimes the numbers seem a little bit scary at the national level, but that has really nothing to bear on the idea of a condo on 3rd Avenue and 67th Street. It has nothing to do with the Miami markets. So just keep that in mind.
Right. I got one more I want to show you. Mortgage-free homeowners. Like, again, look at this. This is crazy stuff. Like this and like how long people are living in their homes. It used to be like 6-7 years. Now it's like 12, that people are living in their homes and trading. The percentage of owner-occupied units without a mortgage is 40%. And it's just been rising, And you think about the cash market in New York City. What is it? 60% cash in New York City? Something like that.
It's 60%. That's right. I mean, it's first of all, yeah, if you look at, I think Resi Club also had a map of where most people were living without mortgages, and the New York City one was like the biggest dot on there because we just do so many cash deals. So I think the general story was that as people are aging, they're paying off their mortgage, they're aging in place, and they don't necessarily move. And there may be some products like reverse mortgages kind of geared to them, but I don't think the national versus local divide in Manhattan, it's not necessarily, and in Brooklyn and New York City for that matter, it's not necessarily the case. Sometimes people just pay cash because, hey, it's just sitting in a bag here, might as well use it.
Totally. Share remote work is going down. Office going back up. I wouldn't be surprised to see office space on a secular uptrend from this pandemic bottom, so to speak. This whole shift that happened with the pandemic. I feel like it's just slowly recovering, and it's just going to continue to go on for a while until it gets back to some of its form from, I guess, 2019 before all this happened.
Yeah, but I think you're definitely seeing recovery in the Class A office space. So the question is, will that follow through? If more people come back, are you going to see the Class B, Class C? Are you going to see those start to appreciate? Because right now, some of those are still in very precarious positions. But yeah definitely the nicer office space has really recovered. Well located, high amenitized office spaces are doing pretty well for the most part.
Yep. And I think that's a cornerstone of Manhattan's comeback, is to see our office sector come back with one of those tentacles to the beast that we have. And finally, guys, I know we put a lot of stuff out there. We're going to circle back to Manhattan. We ran out of time. We couldn't put a title and subtitle on this, but what you're looking at here is basically liquidity, demand, 30-day demand for all the price points. Look on the left, guys, all these dots. That gray line is 1 million and under. The orange is 1 to 2, light orange 2 to 4. Take a little snapshot of this if you want. What I really want to point out on this chart, can I draw over this? I think I can. What I really want to point out over this is the year over year change in all of these price points, guys. And it might surprise you that the 10 million plus sector has actually taken a hit in the last few months. All right. It's taken a hit a little bit. It's down 52% now. It's the 4 to 10 million flat, the 2 to 4 million's up 7.5%, and the 1 to 2 million. I almost feel like this has changed a little bit in the last few months with the little bit of softness that we've had. I mean, because the luxury sector was leading the way for a long period of time. I wonder if that's slowly changing. I don't know, but this is what the data is telling me, Johnny.
It is. And of course, look, this is the slowest time of year. So I'm not surprised, sometimes you can be a little bit lower, but it's almost across the board on the luxury side. It's that middle market, which I'm curious to see. Like, so the under $1 million is still down from last year, but the 2 to 4 actually up. So I'm wondering, as we make our way into this lower mortgage environment, if we start to get, we just talked about cash deals, if we start to get some more finance deals, start to pick that engine back up, that could really power the 2 to 4 and also the under $1 million market, especially again in the fall, which again brings me to my other point. Like, if we have a market that's starting to reignite because we have a market that's up, the stock market that's up, economic worries, you have lower rates, you have mortgages are lower. What happens when there's not that much supply there? What happens when demand meets shallow supply? I don't know.
Yeah. And we're also looking at this kind of at the bottom of the summer move as well. So there's a seasonal element here. We should probably check back in on this in November and just see how these sectors have fared. We'll do that. We'll do another check-in about 2 months and tell you which sectors are doing good on a price tier basis. Yeah. But that's basically it, guys. I mean, if you have any other questions for us, we're about to sign off over here. Someone's asking if we're in an office.
Oh, touche, Dale. No, we're not. But hey, we passed the savings on to you. Cut the middleman out.
That's why this show is free. Right, exactly. Pass the savings on to you. Well, thank you, guys. If you have any other questions, I just want to point out that, tomorrow we're going to be talking something I think is very important, especially if you have a listing. If you have a listing right now and you're going into the fall listing season and all this inventory is coming on, we'll talk about some price reduction strategies, some data points, some tools that you could use to enhance that conversation to maybe up the effect of you guys getting a price cut with your client. That'll be tomorrow at 11 a.m. Other than that, I think we're done here if I don't have any other questions.
Well, I would also just want to point out a quick plug for UrbanDigs Advisors. So if you do need personalized help with a listing, whether it's a pre-listing or a price cut, reach out to us. We do this deep market dive focused on your listing, and it's been pretty successful. So we're very proud of it.
That's right here.
That's UrbanDigs.co, or you can find it on the dashboard right there.
Yeah, it's backed by appraisal as well. So it's a good little service. If you guys need help on that, let us know. Other than that, I will hopefully see you guys on the price reduction strategies tomorrow. Good skill set to have in general. We got a question.
So would you hold off on the listing until November? I would not do that.
No. Put it on. let's show you why. Okay, you go to the chart room. Show you the chart room. Optimal time to list. Right over here, guys. This is going to show us our seasons. This is showing you average deal activity for our seasons, and hopefully there's no drawings over here. Here's our fall season. That's our fall season. So here's your strategy. You list now. Like now is the time to list because the action's starting now. The contracts come in October and November. That's when the contracts come in. So you want to be ahead of it, right? So you list now over the next 2 weeks, perfect time to list. And then if you get to mid-October or the end of October without a accepted offer and suitable traffic, call it the first 2 to 4 weeks. Okay. You have to reduce your price. This is your price cut, PC, price cut, period. So that you still have the remainder of the fall season for the market to engage on your updated price if the market didn't react on the initial price. So you have to kind of plan that accordingly, strategize accordingly. If you list in November, right, and you're not successful, then that means you're cutting your price in December and January, which is 2 low months.
Yeah. Well, the troubling thing about November, right, is you have the holidays. Like once Thanksgiving rolls around, even like the week before Thanksgiving is pretty much the last time we see any kind of like fall volume come in. Obviously, you're going to get some contracts signed after that as that due diligence phase, continues and finishes. But in terms of buyers going to open house, in terms of buyers going out, that volume is pretty much written off until it really starts picking up again in February, but not earnestly until March or so. And you can see that in the contracts. It just kind of gets that seasonal lull. So if you listed in November, you'd basically have a week or 2 weeks to really lure in the buyers and get it right. So if it's priced right,
after Thanksgiving, it goes straight down.
Yeah.
Right. And we got the election coming up. So if your thinking is, I want to wait till after the election, you may want to target spring if that's your thinking. But it's up to you. If you want to list in December and January, it's just not the active season. Okay, guys? Very important. Good topic. All right. We're going to call it a day. Thank you, John Walkup. I am Noah Rosenblatt. We're both with UrbanDigs. This has been Macro Monday. Hopefully, see you tomorrow and next Monday. Cheers, everyone.
Thanks, everybody.